At the beginning of the week, Tesla stock was trounced, falling 8% on Monday after Elon Musk revealed plans for redefining what it means to have a global economy by announcing a multi-trillion-dollar potential humanoid robot that could contribute to artificial general intelligence. If that wasn't enough reason to sell the stock, Tesla also reported all-time record production and deliveries and announced a major new update from its Giga Berlin factory in Germany. Then on Tuesday, Tesla stock proceeded to claw back some of these losses with a 5% upward move midday, only to encounter more sellers upon hearing that Elon Musk would be acquiring Twitter for $54.20 per share as originally proposed. Tesla can't seem to catch a break with a jumbled up mixture of negative news, but with some good things brewing at the company. And before I continue, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and financial data going back 10 years, and it's all freely available. Now, this is where Wall Street and Main Street diverge. While many retail investors see the long-term trajectory of a company like Tesla, Wall Street is trading the stock day by day, minute by minute, and using high-frequency algorithms to take short-term profits. Typically, after a Tesla event, the stock undergoes buy the rumor, sell the news as a consequence, which like clockwork pushes the stock down no matter what was announced. Coupling that with what flashed sell signals to investors was Tesla's delivery number falling short of expectations. Tesla was supposed to deliver about 360,000 or so vehicles as per consensus estimates, but instead it came in at 343,000, about 20,000 vehicles away from the target. A missed target suddenly once again means no more growth at Tesla according to the mainstream media. But Tesla told us something to try and quell the fears in their quarterly update. They said, historically, our delivery volumes have skewed towards the end of each quarter due to regional batch building of cars. As our production volumes continue to grow, it is becoming increasingly challenging to secure vehicle transportation capacity and at a reasonable cost during these peak logistic weeks. In Q3, we began transitioning to a more even regional mix of vehicle builds each week, which led to an increase in cars in transit at the end of the quarter. And here's the line, these cars have been ordered and will be delivered to customers upon arrival at their destination. So this doesn't at all seem to be a case of demand issues, which is the typical analyst concern. Tesla has been bottlenecked for years on supply constraints and continues to be, but as a matter of fact, they actually produced an astounding 366,000 vehicles. So those 20,000-ish cars that they missed on were actually built, and they're going right into the next quarter's numbers. If anything, as of right now, a few days into the quarter, those vehicles are likely all delivered, and so they'll count for the fourth quarter, even if Tesla runs into similar issues in December where they can't deliver a few thousand cars that they just produced in the last few days of the month. Though usually Tesla offers some level of perks to consumers at the end of the year to try and deliver every last vehicle they have, even showroom vehicles sometimes, to clear out all of their inventory and get as much as possible into the year-end numbers. Now, CNBC went all out and started listing everything wrong with Tesla while they were reporting on their deliveries. They said, in the third quarter of 2022, Tesla faced soaring commodity prices, executive turnover with the notable departure of AI leader Andrej Karpathy in July, and growing pains at its new factories in Germany and Texas. Now, none of these actually have much to do with deliveries, but why not throw them in? Soaring commodity prices may counterintuitively end up being a good thing for Tesla. Inflation has been affecting all car makers, and yet Tesla has still been able to grow 42% in the current quarter over last year in terms of deliveries. But Tesla is in a fairly unique situation where they've been able to significantly raise prices on vehicles and still grow unit sales, whereas most automakers have seen their sales decline over the last few years. Elon Musk expects input costs for vehicles to start coming down as commodities have begun falling in price. Tesla can lower the price of their vehicles more slowly than the rate at which their costs come down and boost their margins over the next few years to new highs. Another interesting development that has just been announced is that they will no longer be building cars with the 12 ultrasonic sensors that are used for parking. Instead, these will be replaced with Tesla Vision. Tesla's occupancy networks, which we talked about in this video here, are now good enough to no longer need these sensors. Now, the sensors themselves may be relatively cheap for Tesla, perhaps a couple dollars each, though Tesla did at one point develop sonar technology that could go through metal, which it needed to hide the ultrasonics in the Model X Falcon Wing doors. Nevertheless, when multiplied by millions of cars, these 12 sensors in each car start to add up, not to mention the factory machinery required for assembly. We've even seen car expert Sandy Munro talk about using the same types of screws to save money, so removing 12 sensors and everything that's needed to support them could lead to meaningful savings over time, which will further boost Tesla's margins. CNBC also mentioned Andrej Karpathy, Tesla's AI lead, leaving in July. He technically wasn't at the company for 4 months earlier than that, but he's played a key role in helping Tesla get to where they are today. At Tesla's AI Day 2022, it seemed like the company had a deep bench of AI experts, and also there was a funny Easter egg during the AI Day presentation. Watch what Elon Musk says here.
Way faster and for less money. And as the world transitions to software 2.0,
and that's on the bingo card.
as someone I know, it has to not drink 5 tequilas. Let's see. Software 2.0
Yeah.
will use...
If you Google for Software 2.0, you find it to be Andrej Karpathy's concept. And on Twitter, as he's eating his AI Day popcorn, he says that he's been dared to take 5 shots of Tesla tequila every time someone says Software 2.0 during the presentation. And then Elon Musk says it twice. So it seems that although he's left the company, he's still a fan of and friends with people at Tesla. But it seems now that Tesla is on a path to accelerate their AI capabilities, even if Andrej Karpathy is no longer on the team. CNBC also mentions growing pains at Tesla's new factories, Berlin and Texas. This sounds like a bad thing, but yes, of course these factories have started from nothing and need to grow deliveries, though they do seem to be making great progress. But this isn't related at all to the delivery miss. The miss in deliveries is because Tesla has too many cars to deliver right at the end of the quarter, and it costs too much to expedite these deliveries in order to get them in by the last day of the month. Instead, it's cheaper to just wait a few extra days. Tesla misses the quarter, which is bad for investors, but it's the right thing to do for the company since they save money and these vehicles show up in the following quarter. Furthermore, Giga Berlin and Texas are each producing a relatively small number of vehicles compared to Tesla's Giga Shanghai and Fremont, and so a 20,000 excess of vehicles in the last few days of the quarter can't possibly be coming from Berlin or Texas since they're simply not there yet. So mentioning the growing pains is unrelated to these 20,000 late deliveries. But it's interesting because Wall Street loves the company Rivian, though so far Rivian's delivery growth this year has been fairly linear. They had a 260% growth rate in deliveries in the second quarter over the first, but then this quarter deliveries grew at 47%. Rivian is growing off a small base of cars, so their percentage growth should be high. Like going from 1 car to 3 cars is a 200% increase, but it's not very many cars. It's impressive growth, but they're still in the single-digit thousands. Tesla grew 35% over the last quarter off a 250,000 car base. Rivian also seems to have the same problem as Tesla, where they produced about 12% more cars than they delivered in the quarter. Tesla's 20,000 car miss was just 6% more production than deliveries. So technically Rivian is having more trouble delivering fewer cars than Tesla, and they've called for a higher operating loss for the full year due to rising costs. But Wall Street is okay with that, but not with Tesla. The argument can be made that Tesla is an A+ student that perhaps got a 95% instead of a 100% on a test, whereas Rivian is a D student going to a D+, which is more exciting for them. There are some underlying stealthy trends at Tesla that shouldn't be discounted, however. Because of Tesla's size, it's masking some impressive growth in certain parts of the company. Giga Berlin started delivering its first vehicles in late March of this year. Just for reference, Rivian started delivering vehicles in late 2021, but they're new to the game. Giga Berlin started in March, and by June, about 3 months after they started, they reached a milestone of 1,000 vehicles being produced per week. And then this past weekend, which is just another 3 months later, they announced a run rate of 2,000 cars per week. So Giga Berlin quietly doubled its production in the last 3 months, giving it a run rate of 100,000 cars per year. This seems to have been ignored by those focusing on just the short term and forgetting where Tesla could be even as early as the end of this year. But the market has again shifted its focus to Twitter as Elon Musk seems to now officially be buying the company for $44 billion after a long court battle and flip-flopping on trying to walk away from the deal, likely to see if the price could be lowered. One of the worries that stem from this is that he might need to sell more Tesla stock to pay for the deal, and the other main worry is that he will become distracted with trying to fix Twitter. It seems that Elon's goal, however, is to direct the company to follow his new vision for Twitter, so it will eventually run itself, just as Tesla's 100,000 plus employees don't depend on Elon telling them what to do day by day. The company is fairly autonomous. If anything, there may be some positive synergies that aren't being accounted for between Tesla and Twitter, since Twitter is a massive social and advertising network. Now, amidst all the negativity, this could lead to an impressive year for Tesla. In this quarter, Q3, which Tesla will report on October 19th, they had record deliveries, about 33,000 more cars than the first quarter of the year, and that quarter was a blowout in terms of earnings. They earned $1.07 per share back then, with 310,000 vehicles sold. Now, in the second quarter, Tesla China was shut down, and they still had an impressive quarter, even with one hand tied behind their backs. But now Tesla is back with a vengeance, as Elon Musk predicted, yet the analysts are forecasting $1.03 per share. Now sure, there could be many variables at play, but their forecast is lower than what Tesla actually earned in the first quarter of the year, and now there's some very nice tailwinds. Again, they delivered 343,000 cars. That's 33,000 more cars than the first quarter. Also, although commodity prices are rising, Tesla has raised prices over time, and these raised prices will start kicking in now as Tesla has delivered those backlogged cars with the increased prices. Even though raw costs were up too, Tesla tends to try and keep their margins around constant with their forecasting, and so same margins but higher revenue means more gross profit. And a third major tailwind is Model S and X. Look how they've increased Model S and X deliveries over the last 6 months, from 14,700 in Q1 to 18,600 in Q3. Again, we're comparing it to Q1 since that quarter was the record. But another 4,000 Model S and X at say $100,000 each to be conservative, since these vehicles are actually priced higher than that. But that's an additional $400 million in revenue, and these are high margin vehicles and could meaningfully contribute to higher profit. It's also worth noting that the percentage of people leasing has gone down over this time as well, from 17% in Q1 to 10% in Q3. It's much better for earnings to get the full cash payment up front. So this is another small boost to the benefit from Model S and X. So I think that although Tesla did fall short on deliveries, the production numbers were quite impressive, and they did explain that the missed deliveries would simply appear in the following quarter. There are multiple tailwinds that should help this quarter be better than the first quarter of the year, the last time Tesla had record earnings and deliveries, and yet analyst estimates are forecasting the upcoming earnings to be worse than the first quarter. While in the short term, Wall Street traders may try to capitalize on negative headlines, but over a long time horizon, the retail investor strategy diverges from Wall Street's as the future looks quite bright for Tesla. So do you think that this upcoming third quarter will be a new record for Tesla in terms of earnings? And how do you think Tesla will finish off the full year in terms of deliveries and earnings despite all of these negative headlines at play? If you enjoyed this video, have a look at my last video on Tesla's AI Day robot and how it stacks up to Boston Dynamics. Please hit the like button and subscribe, we would really appreciate that. And a huge shout out to all of our patrons that helped us support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.